Welcome to Homebuyers School, brought to you by Brookfield Residential.
Hi everyone, welcome to another Homebuyer School video, a channel where you get the latest strategies, tactics, and tips from home buying experts. And remember, if this is your first time on this channel and you want to get the latest strategies from the experts, hit the subscription button below, hit the little notification bell so you don't miss anything. So today I'm joined by Mushtaba Sayed, Manager Mobile Mortgage Specialist with TD Canada Trust. And today the question we're going to answer is, how has the recent interest rate hikes actually impacted mortgage rates?
Yeah, it's a great question, Carl. So interest rates, when they go up, they impact your payments, right? So the higher the rate is, your payments are affected by that. So when prime has gone up, so anyone that was in a variable rate, their payments have gone up, right? So they most likely saw that they're now paying more on a monthly basis. Also, the interest cost has gone up. So interest cost, what it is the cost of borrowing when you actually go lend to a bank, right? So you end up paying a printable portion, which is what you borrowed, plus whatever the interest portion is, what the banks have kind of charged you for the money that you've borrowed from them. So when prime rate or variable rate goes up, your payments go up and so does your interest cost.
So I know we were talking about this before we had this segment. So whenever interest rates go up, that doesn't necessarily mean mortgage rates go up, right?
Well, it really just depends on what interest rates are going up, right? So if the Bank of Canada raises the overnight rate, which we call technically prime rate, so the Bank of Canada raises their overnight rate, and then that impacts the bank's prime rate. So, but they're not really tied into fixed rates, right? So if prime rate goes up, yes, variable rates go up. Credit cards, if you have a variable credit card, those goes up. Any lines of credits, anything tied to a variable rate will go up. Anything that's in a fixed rate will not go up, right? Fixed rates are based on the bond market. So like a 5-year fixed rate is kind of based on a 5-year bond yield. Very different, they're kind of correlated. One is not really tied into the other. There have been instances where prime rate has gone up and the banks have raised fixed rate, and that's just technically a coincidence, but they're not technically tied together. If prime goes up, not necessarily fixed rates will go up. In the last couple of years, last 4 or 5 years, when mortgage rates were historically low, prime rate didn't change a lot for a matter of 4 to 5 years, but we did see fixed rates kind of go up, kind of come down, and come down lower, and then went back up a bit. But they're just like I said, they're not really tied together.
So let's say you're in a fixed rate right now, and the Bank of Canada raised their overnight rate. You probably won't be affected.
That's correct,
right?
Yeah. So one of the benefits of going into a fixed rate is that you're not really impacted with any changes, right? With the Bank of Canada or interest rates or where even the economy is. So you do pay a little bit of a higher rate compared to a variable sometimes, depending on that, to get that safety and security. But for that 5-year fixed term or a 3-year fixed term, whatever the fixed term is, you are locked in. You don't have to worry about rates rising and impacting your payments or impacting your interest charges. Once again, another great conversation to have with your lender to see if that's something that would impact you and to see what's best for you, a fixed versus a variable.
So a lot of news right now, and I think a lot of potential home buyers are concerned about, is how has the recently increased rates actually impacted the ability to buy a home?
Yeah, I think most people are really just worried more now about where interest rates have gone. Yes, they used to be historically low, but keep in mind this is not what I would call abnormal. In the history of rates, we've seen rates go up, we've seen it come down. 6 years ago, rates were very similar to what they are today. We did have a short time period where rates were historically low. And when I mean historically, like never in the history of Canada. But that's not a normal. That's also not a good thing. We don't want rates to be that low because it kind of tells us how our economy is doing. So rates are going up, prime rates going up. In a way, it is beneficial for us. It says that we as a whole, as our economy is doing a little bit better. But it is going back to what we call normal. So it's not normal for it to be as low as it used to be. And yes, it's an inconvenience to pay a little bit of a higher rate, but it's whatever is available at that time in the market.
So just to let you know, if you want to know more about interest rates and buying a home, check out our video above. So Mo, one thing that I kind of wanted to know, and we've already talked about the mortgage stress test, right? And we're going to do more videos on that. Again, we have another video on the mortgage stress test above. But how has the increased rates actually impacted the ability to qualify for mortgage?
That's another really good question. So a stress test is calculated in 2 separate scenarios. So we have a scenario, what we called an insured mortgage, which is something that you get when you put less than 20% down. And we go through something called default insurance, which is CMHC, Genworth, Canada Guarantee, as you might have it. For them, is this a 5-year posted rate, whatever the bank account's 5-year posted rate is. So a 5-year posted rate is not technically the rate that you get. Most banks actually give a discount off their posted. But for example, today's 5-year posted rate is 5.34. So it doesn't matter what rate you go with. If it's an insured mortgage, you will have to qualify at that 5-year posted rate. Now, if you go for a conventional rate, that's where the rules changes a little bit for the stress test. So if you're putting technically 20% down or more, and you're not having an insured product, you would technically, the stress test is calculated a little bit differently. So they could take a look at your rate, and they can add a 2% premium on top of that just as a qualifying rate. So for example, let's say if the 5-year fixed today, for example, is 3.6, they could charge you 5.6, which is 2% more. So it really just depends. So in that point, if you're putting more than 20% down, interest rates going up also impacts your qualifying rate, which also goes up, and then you qualify for less.
So is it kind of like with the increased rates, is it better to put down 20% or more, or is it actually better to put like the minimum at 5% down?
Once again, it really just depends on your own financial situation, something that you would want to sit down with your advisor, lender, specialist, etc., to kind of talk about, to say, I do have the option of putting 20% down. Is that going to be more beneficial to me based on getting a lower rate, easier qualifications? And they can discuss that with you. Now, it's not necessarily just because you qualify for higher that you should go with an insured product, because there's a cost to having an insured product, right? And that cost will most likely be built into your mortgage, which kind of compounds with the interest rate that you pay. Even though it's a lower interest rate, you might end up paying more in the long term. So you do want to have that discussion with your lender, specialist, and see if it makes sense for you to put 20% down. Sometimes it makes, even with the higher qualifying rate and a slightly higher interest rate, it still makes more sense to put that over the long term. It comes also a conventional product, comes with more perks than I guess someone like the insured product does. If you're putting 20% or more, sometimes you have the ability of going for a 30-year amortization instead of a 25-year, which is the cap on an insured product. So it gives you the ability to lower your payments and then kind of go on that. So once again, a great discussion to have with your lender.
Perfect. Do you have anything else to add?
No, I think that should be it.
Great. The question I have for you is, has the recent interest rate hike actually impacted your ability to buy a home? Let us know in the comments below. Well, thank you very much for joining us, and we'll catch you next time.
That's another edition of Homebuyer School. Tune in next time for more expert tips and tricks. And visit homebuyersschool.ca to bring you one step closer to finding your dream home. As with everything, it would be great if you like and share our videos. Also, please let us know if you have any home buying questions you want us to answer.